Okay. So have you ever looked at venture capitalists and thought, like, how do they pick the winners?
Yeah.
Today, we're doing a deep dive into venture science,
All right.
a firm that ditches gut feelings and uses hardcore math.
Love it.
So this is going to be a fascinating look behind the curtain.
Absolutely.
Tell me, how is venture science different from like the typical Silicon Valley venture capital firm?
Yeah, you hit the nail on the head. It's all about the numbers at venture science.
Okay.
We've replaced the typical intuition-driven approach that a lot of VCs use with a quantitative probability-driven model. We like to say we let the data guide us to the companies with the potential to be the next big thing.
So it's not just about like a brilliant idea
No.
or charismatic founder.
It's about so much more than that.
Okay.
To understand our process, you first need to grasp the inherent risk in venture capital.
Okay.
Did you know over 60% of ventures fail to return any capital?
Wow. That's a pretty sobering statistic.
It is. And only around 10% achieve those incredible 10x returns that everyone dreams of.
Right.
In fact, the top 1% of investments often drive the entire performance of a fund.
Wow.
So the odds are stacked against you from the start.
Yeah.
It's like searching for a diamond in a coal mine with millions of dollars at stake.
So how do you even begin to separate the potential winners from the rest?
Yeah.
How do you find that diamond?
That's where our secret weapon comes in.
Okay.
Multi-criteria decision analysis,
Mhm.
or MCDA.
MCDA.
It's a structured framework that we use to evaluate potential investments across a range of factors, but we go way beyond simple metrics.
Okay.
We consider technological differentiation,
Okay.
market opportunity, the regulatory landscape,
Makes sense.
competitive positioning, capital efficiency,
Uh-huh.
and of course the team's strength.
Of course.
Each of these factors is weighted based on its importance, which allows us to score and rank potential investments in a truly objective way.
It sounds incredibly thorough. Is this what sets venture science apart from like the traditional firms?
It's definitely one of the key differentiators.
Okay.
You know, this rigorous process helps us avoid biases and ensures that only the most promising companies make it through our selection process.
Right.
And because we're looking at so many different factors, sometimes MCDA highlights opportunities that a traditional VC relying on heuristics might overlook.
Interesting. So it seems like you're taking a much more analytical and comprehensive approach
We try.
than compared to like traditional VCs.
Yeah.
But I have to ask.
Yeah.
Let's say you've identified a potential winner.
Yeah.
How do you decide how much to invest?
Yeah.
Is there a formula for that? And well,
You bet there is.
okay.
We leverage something called stochastic finance to construct optimized venture portfolios.
Oh.
Unlike traditional VC funds that often allocate capital in fixed proportions without modeling the complex probabilities involved, we embrace the uncertainty by running thousands of simulations,
Yeah.
each representing a potential future for the company and the market.
Okay, now you have to break this down for me.
Sure.
What exactly is stochastic finance?
Yeah.
And how does it work in practice?
Yeah.
It sounds incredibly complicated.
It might sound intimidating, but the concept is actually quite intuitive.
Okay.
Imagine you're trying to predict the weather.
Okay.
You can't just look at the temperature today and assume it will be the same tomorrow, right?
Right.
Instead, meteorologists use complex models that consider various factors like wind patterns, humidity, and historical data to create multiple potential weather scenarios.
All right.
Stochastic finance works in a similar way.
So you're saying you're running thousands of simulations for each potential investment,
Yeah,
taking into account all sorts of variables.
exactly. We factor in things like failure rates, dilution risk,
Right.
market cycles, liquidity constraints,
Yeah.
even the volatility of returns.
Wow.
It's all about acknowledging that the future is uncertain and using that uncertainty to our advantage.
Mm-hmm.
By quantifying these possibilities, we can maximize the expected value of our investments while ensuring we have sufficient capital reserves for follow-on investments and managing risk effectively.
This is fascinating.
Yeah,
It sounds like you're taking a very calculated approach,
very much so.
and it's clearly working.
We think so.
But tell me, how do you decide the specific amount of money to invest in each company?
Yeah.
Is there a secret formula?
You could say that we use the Kelly criterion.
The Kelly criterion. Interesting.
It might sound surprising, but it's actually a concept borrowed from the world of gambling.
Wait, hold on. Are we talking about the same Kelly criterion used in like blackjack and poker?
Yes, while it might seem unusual, the principles apply beautifully to venture investing as well.
Wow.
The Kelly criterion essentially helps us determine the optimal fraction of capital to invest in each deal based on the probability of success and the potential return. So we're not just picking winners, we're also meticulously planning how to manage the inherent risks that come with venture capital.
This is blowing my mind.
It's a powerful concept.
So you're using a mathematical formula to avoid overbetting or underbetting on any given company.
That's right.
I love how venture science is connecting these seemingly disparate fields.
We like to think outside the box.
Okay.
The Kelly criterion ensures we deploy our capital efficiently across a diverse portfolio of high potential opportunities.
Yeah.
And we don't just use it once.
Right.
We actually have an expanded stochastic Kelly model that guides our follow-on investments and lets us dynamically rebalance our portfolio over time.
This is incredible.
Yeah.
You're taking the guesswork out of venture capital and replacing it with data-driven decisions.
As much as possible.
But does this mean human intuition plays no role at all in your process?
That's a great question, and one we grapple with constantly. While our foundation is built on quantitative analysis, we do recognize that certain qualitative factors can't be easily captured in a spreadsheet.
Like what?
Things like the founder's vision,
Right.
their adaptability,
Yeah.
and the overall market sentiment.
So it's not a complete rejection of traditional VC wisdom, but rather an evolution,
That's right.
a blending of the best of both worlds.
Exactly. We see our approach as augmenting human judgment, not replacing it entirely. By providing a robust analytical framework, we can make more informed decisions.
Right.
But we also need to be adaptable and open to new information as it emerges. It's all about striking the right balance.
I'm really starting to see how venture science stands apart in the VC world.
We like to think so.
This data-driven approach is truly fascinating.
It's very powerful.
And I'm eager to dig even deeper.
Happy to share.
What are some specific examples of how venture science has used these methods to identify and invest in groundbreaking companies?
Yeah.
Tell me more about some of your success stories.
Sure, let's dive in.
All right, of all years, give me the inside scoop on some of venture science's biggest wins.
Okay.
How have you used this unique approach to pick companies that really took off?
Well, one example that comes to mind is Ripple,
Wow.
a company that's using blockchain technology to revolutionize cross-border payments. Back when we first invested, cryptocurrency was still a fringe concept even in Silicon Valley.
Yeah, for sure.
But our analysis showed there was a massive market opportunity and a team with the technical skills to execute. Of course, the regulatory landscape was uncertain, but we factored that risk into our models and ultimately decided it was a bet worth taking.
And it certainly looks like that bet paid off.
It did.
Ripple has become a major player in the fintech space.
For sure.
What about another example?
Sure.
I'm curious to see how this works across different industries.
Let's look at Circle,
Circle.
a global internet finance company that's at the forefront of the stablecoin revolution,
Cool.
which aims to make financial transactions faster, cheaper, and more accessible.
Okay.
Our due diligence process highlighted their robust technology, the experience of their leadership team, and their compelling vision for the future of finance.
Got it.
Plus, their approach to regulatory compliance aligned perfectly with our risk tolerance.
These are great examples.
Mm-hmm.
But I'm particularly interested in how stochastic finance plays a role in these success stories.
Yeah.
It's one thing to identify a promising company,
Right.
but it's another to make the right call on how much to invest and when.
You're absolutely right. It's not just about picking winners. It's about managing the entire portfolio for optimal returns.
Right.
Take Circle, for example. The initial investment was just the beginning as they hit milestones, and the market evolved. We needed to decide when and how much to invest in subsequent funding rounds.
Okay.
That's where stochastic modeling really shines.
Uh-huh.
It allows us to play out various scenarios, anticipate potential challenges, and make data-driven decisions about follow-on investments.
So with Circle, your models helps you navigate those decisions, maximize potential returns, and stay within your risk parameters.
Exactly. It's like having a financial GPS that guides us through the ever-changing landscape of the market. We're constantly running these simulations, adjusting our strategy based on the latest data and market conditions.
That makes a lot of sense.
Yeah.
But some critics might argue that this data-driven approach is too cold and calculated.
I understand that.
What about those intangible qualities that are hard to quantify, like a founder's passion or a team's chemistry? Can those really be captured in a spreadsheet?
That's a great point, and I understand where those critics are coming from. While our models focus on quantifiable data, we absolutely don't discount the importance of those intangible qualities.
Okay.
In fact, we spend a significant amount of time getting to know the founders, understanding their vision, and assessing their ability to execute.
So how do you assess those softer aspects?
Yeah.
Do you have metrics for things like team dynamics and leadership qualities?
We do have certain metrics for those, but you're right, those can be more subjective.
Yeah.
We rely on our experience, our network, and our gut feeling to a certain extent.
Okay.
But even then, we try to be as objective as possible. We look for patterns, we talk to references, and we try to gather as much information as we can to support our intuition.
It sounds like a delicate balancing act.
It is. We see our quantitative approach as a framework, a foundation upon which we can build our investment thesis.
Yeah.
But ultimately, it's the human element, the intuition and judgment of our team that guides the final decision.
Yeah.
We like to think of it as a harmonious blend of art and science.
This makes a lot of sense, and it seems like this hybrid approach is working really well for venture science.
We think so.
But I have to ask about the bigger picture.
Sure.
Do you think this data-driven approach will become the industry standard in the VC world? Will other firms have to adapt to compete?
I think it's inevitable as the industry matures and competition intensifies. VCs will need to find ways to differentiate themselves and prove they can generate consistent returns.
Right.
A quantitative approach grounded in data and rigorous analysis offers a significant competitive advantage.
Yeah.
I believe we're at the forefront of a major shift in the industry.
So venture science is not just playing the game.
Nope.
You're changing the rules of the game.
That's a great way to put it. We're not just looking for the next unicorn. We're trying to build a better system for identifying and supporting the companies that will shape the future.
It seems like data-driven decision-making is a core part of every stage,
Absolutely.
from the initial screening all the way to capital allocation.
Yep.
But what about industries that are harder to predict, like space exploration?
Yeah,
I know you have Axiom Space in your portfolio.
we do.
How did your models handle that one?
Axiom Space is a really interesting case. They're building the world's first commercial space station, which is an incredibly ambitious endeavor. It's not easy to predict the future of the space industry. There are so many unknowns,
I can imagine.
from technological advancements to government regulations to geopolitical factors.
It's definitely not like analyzing the market for software or consumer products.
Right.
There's a lot more uncertainty.
Right. But even in a complex and unpredictable industry like space exploration, data can be incredibly valuable. We gathered a ton of information on the emerging space economy. We analyzed historical trends and we modeled various scenarios. We also factored in things like Axiom's strong team, their partnerships with NASA and other key players, and their innovative approach to commercializing space.
So you were able to find those data points,
Yeah.
those signals and all the noise that gave you confidence in Axiom's potential.
Exactly. And while no one knows exactly what the future holds for space exploration, we believe Axiom is in a great position to capitalize on this rapidly growing market.
These case studies are so helpful in understanding how venture science operates.
I'm glad to hear that.
It's clear that your quantitative methodology is not just about crunching numbers, it's also about understanding the nuances of each market and making calculated bets on the future.
It's all connected.
But I have to ask, even with the most sophisticated models, can you completely eliminate the role of luck in venture capital?
That's a question that every VC grapples with. Of course, luck always plays a role, but our goal at Venture Science is to minimize our reliance on luck and maximize the impact of informed data-driven decision-making by using a rigorous and systematic approach. We believe we can significantly improve our odds of success, even in the face of uncertainty.
So you're not claiming to have a crystal ball,
Nope.
but you are using data to make more informed decisions and manage risk.
Exactly.
It's like you said before, it's a blend of art and science.
That's a great way to put it. We're not trying to predict the future with perfect certainty, but we are using data and analysis to make smarter decisions and manage risk more effectively. And ultimately, we believe this approach is not only good for our investors, but for the broader innovation ecosystem.
I think that's a great point by taking a more data-driven approach. Venture science is not only changing how venture capital works, but also helping to shape the future of technology and innovation.
We hope so.
This has been an absolutely fascinating deep dive into your world.
It's been a pleasure.
What final thoughts would you like to leave us with?
I'd simply say this, the future of venture capital is data-driven. Embrace it, explore it, and challenge the status quo. There are so many groundbreaking companies out there waiting to be discovered.
I love that. And to our listeners, keep exploring, keep asking questions, and keep pushing the boundaries of what's possible. Until next time, this is The Deep Dive signing off.